Hi, this is Mortgage Moments with Mark, and today I'm with Steve Wolf, who is with Cherry Creek's Reverse Mortgage Division. Steve, reverse mortgages have been around for a while, but could you please share what some of the common misconceptions are?
I'd be delighted to do that, and thank you for inviting me today. This program prior to 1989 was a program that was fraught with problems. It was a conventional loan. It did not have any government oversight. There were title issues, there were equity issues that became involved, and up until 1989, this program was not a very good program for the borrower. In 1989, the Federal Housing Administration, FHA, took over the program, and as a result, it has been completely retooled. The program is the most highly regulated home loan product in the United States with tremendous federal oversight, and the product has really blossomed. The use of the product has really blossomed since 1989.
Great, thank you for bringing us up to speed on that. Now, when people hear the term reverse mortgage, primarily I think they think of a refinance. However, is that its only purpose?
Historically, since 1989, 99.9% of the loans that have been done have been the reverse product. However, the product has been so well received by FHA and the community in general that FHA has added a purchase component, and that purchase component has been around for approximately a year. What that basically means is an individual that's wanting to buy a new primary place of residence. That could be a single-family residence, it could be a manufactured home that was constructed after 1976, it could be an approved FHA condominium project. They are able to buy that home utilizing a reverse mortgage. They don't have to go through the traditional income qualifications. They are not subjected to the traditional credit qualifications, including credit scoring. The big benefit is that they don't have any mortgage payments as long as they live in the property. The loan becomes due and payable when they're no longer living in the property, and that would obviously either be by them passing away in the future or perhaps selling the property down the road.
Very good. One last thing I think I would like to have addressed today, if you don't mind, is when would you recommend that someone not do a reverse mortgage? Because this isn't for everyone, obviously.
That's correct. First of all, you have to be 62 years of age. The youngest borrower has to be 62 years of age. The program does require, on a refinance, substantial or significant equity in the property, and on a purchase it requires a significant or substantial down payment. For example, somebody at the age of 62 buying a home would have to come up with about half the purchase price for their down payment, and the reverse mortgage would finance the remainder. So you've got to be 62 years of age, you have to have significant equity or cash to do the program. Also, one concern that a lot of borrowers have is what will this do to their estate down the road? Their hope is that perhaps they could pass a property on to their estate or to their heirs, and they're concerned a little bit about this product because if property values don't increase, that is, they stay stagnant or fall, this loan balance on a reverse mortgage rises over time with the interest that is added onto the loan every month that becomes due and payable at the end of the loan. So as a result, if property values stay stagnant or fall, the equity in time is eroded for the heirs. Obviously, it's not a tremendous concern for the borrower that's living in the property because the loan never comes due and payable, and there's no mortgage payments as long as they occupy the property. Another thing that I think needs to be at least addressed is the fact that this product is not recommended to generate funds to be used to speculate in the stock market to buy stocks and bonds. It's a very good program if the borrower wants to utilize it to perhaps fund life insurance policies or perhaps fund long-term care, but it's not really designed for people that are trying to speculate on their properties. The last thing I'd like to mention is the fact that the closing costs on a reverse mortgage are calculated different than they are on a traditional loan. Since this product does not have any monthly payments required, and there's mortgage insurance that is in place for the protection of the borrower, the closing costs on a reverse mortgage are about double what they would be on a traditional loan. The benefit is significant, but the closing costs are an issue that a lot of people shy away from. I think if a person looks at the closing costs, looks at the benefit, looks how this program is not designed for everybody, but if it feels right, the program will deliver a quality product.
Great. I really appreciate you sharing all this information with us today. I hope that if you find the information helpful, that you forward it on to any of your friends, family, etc., that could benefit from this. If you have questions, you can feel free to contact us directly, or you can even contact Steve directly. Hope you have a great day. This is Mark Sheck with Cherry Creek Mortgage. Thanks.